back to Money Talks. I'm Mia Lee, escort, stripper, CPA, and recovered banker. Today, we're going to talk about diversifying your investment portfolio. The basic tenet of diversifying your investment portfolio starts with asset allocation. Asset allocation is the process of dividing your investments between stocks, bonds, and cash equivalents. Each of these asset types has its own level of risk and potential return. Stocks or equity carry the highest risk and return. Bonds or credit are less risky than equity. Finally, cash equivalents are the safest but offer the lowest returns. By mixing these in the right proportions, you can create a balanced portfolio that suits your financial goals. Let's start by understanding stocks, bonds, and cash equivalents. So most of us understand stocks. They're just fractional shares representing a small piece of company. Bonds, however, are $1,000 loans that carry interest payments made to corporations or governments. The price you pay for a bond can be more or less than its $1,000 face value. If you pay more, it's called buying a bond at a premium. If you pay less, it's buying a bond at a discount. The price fluctuation happens in the bond market and reflects changes in interest rates, the bond issuer's creditworthiness, and other factors. The yield of a bond is a measure of the return you can expect to get from the bond, calculated based on the interest payments, which are called coupon payments, and the price you paid for the bond. If you buy a bond at a premium, its yield, or the effective interest rate you'll earn, will be lower than the bond's coupon rate because you paid more upfront. Conversely, if you buy a bond at a discount, the yield will be higher than the coupon rate since you paid less for the bond. The market yield of a bond is influenced by its market price, but calculation for the yield is a bit more complex than just the coupon payment divided by the market price. It also takes into account factors like the time until the bond matures and the face value of the bond. So yield is the effective rate of return on a bond that's influenced by various factors, including interest rates, time to maturity, and the credit quality of the issuers. Just like you as an individual have a FICO score, bonds also carry a credit rating. It's usually denominated in letters like AAA, double B minus, et cetera, et cetera. The more A's, the higher the letter, the better. Riskier bonds tend to be cheaper and have higher yields because higher risks require higher payouts. So many of us who already have investment portfolios already hold stocks and ETFs, but here's why we should consider bonds and cash equivalents as well. It's all about risk management. Bonds can provide a more stable income stream through regular coupon payments, which is especially beneficial during times of market volatility. Cash equivalents are really good instead of holding cash because they're not really meant to make you any money. They're meant to protect your cash from inflation. I keep about 5% of my portfolio in cash equivalents because this is money that I'm expecting to deploy any day now, but I don't want to lose money on inflation while I'm holding this liquidity. But let's talk about the role of ETFs in diversification. It would cost you over $100,000 to buy one share of every stock in the S&P 500 to achieve total market diversification just for large cap US equities. This is a pretty unrealistic number for most retail investors. Even if you could spend over $100,000 buying every share in the S&P, that only gives you diversification across large cap US equities. You would still need exposure to mid cap, small cap, foreign, et cetera, and also bonds and cash equivalents. You'd also have to buy more than one share of every company in the S&P 500 to maintain total market diversification because you'd have to rebalance this to maintain equal exposure as prices of stocks go up and down. That's not very realistic for most of us retail investors to put together our own indices. Enter ETFs or exchange traded funds. Instead of buying every share in the S&P 500 for over $100,000, you can buy shares in something like the Vanguard 500 S&P ETF, ticker VOO. Those shares run about $450 as of February of 2024 when I'm recording this. By buying shares in this ETF, you can gain exposure to the entire large cap US equity market or the entire S&P 500. ETFs are really cool because you can buy and sell shares of ETFs just like stocks, and they're extremely flexible. Another cool thing about ETFs that people might not know is that they're not limited to equities. You can also buy a bond ETF. For example, the Vanguard Total Bond Market ETF, ticker BND, provides broad exposure to the US bond market. So these bond ETFs are particularly useful since individual corporate bonds are often sold in large denominations, typically $1,000 each, making direct investment way less practical for most retail investors. Buying bond ETFs is safer than buying single bonds because they spread out the risk of interest rate changes and also defaults by individual issuers. Beyond corporate bonds, there are also government bonds, and the most well-known type of government bonds are treasuries issued by the US government. But there are also municipal bonds called munis that are issued by state and local governments. Treasury ETFs, like the iShares 20+ year Treasury bond ETF, ticker TLT, will give us broad exposure to long-term US Treasury bonds. Now, generally speaking, government bonds tend to have a lower yield than most corporate bonds, but are generally considered safer investments because there's a low chance of losing your money since governments can essentially tax or put money to pay their debts. Municipal bonds, or munis, are a special kind of loan that you can give to local governments, and they come with a really big perk. you don't have to pay federal income taxes on the money you make from them. So if you buy munis issued by your own state, you might not even have to pay state taxes on your earnings either. This is really attractive if you're trying to keep more of your money away from taxes. On the other hand, treasury bonds, which are loans to the federal government, don't have the same tax break. You'll have to pay federal taxes for sure on the interest you earn. They might offer you more money up front than munis, but after you pay your taxes, the difference might not be as big as it seems. But here's where it gets really interesting. Because of the tax breaks, munis usually pay less money up front, this is called the yield, than treasuries. But if you take into account how much you save on your taxes, munis can actually end up giving you more bang for your buck. The adjusted earnings, considering the taxes you save, is called the tax equivalent yield. For someone in a higher tax bracket, this means munis could actually be a smarter choice because after taxes, you're effectively earning more than you would with treasuries. Now that I've talked about stocks, bonds, and cash equivalents, I want to focus on the importance of rebalancing your portfolio periodically. With a long-term investment horizon, many financial advisors will recommend that you subtract your age from 100 and hold that proportion of stocks and the balance in bonds. So for example, I am 35 years old, and if I were to follow this rule, which I don't, I would be holding 65% of my investment portfolio in stocks and 35% in bonds, with the remaining liquidity that I want to maintain in cash equivalents. That's because take 100, subtract my age, 35, you get 65-35 split, stocks and bonds. Another traditional measure would recommend a 60-40 split between stocks and bonds. There's really no right or wrong answer to this. I'm actually not following either of these. Instead, I'm holding 80% stocks, 15% bonds, and 5% cash equivalents because I'm very risk tolerant and have a very long-term investment horizon, meaning I'm not planning on using the money in my investment portfolio for about 30 years because I'm a workaholic and who knows if I'll ever retire. But that's neither here nor there. Just because I'm not planning on using the money in my investment portfolio doesn't mean I don't have to rebalance it 2, 3, or 4 times a year. Balancing is the process of realigning the balance of assets in your portfolio, and it involves periodically buying or selling assets to maintain your original desired level of asset allocation. So why is this important? Let's say I started with a mix in 2023 of 80-15-5 stocks, bonds, and cash equivalents. Equity markets were really strong in the second half of 2023. My stock allocation jumped to nearly 90% by January of 2024, which exposed me to more risk than I had initially planned for. In January, I sold some stocks, bought some bonds, and some cash equivalents to get back to my originally intended allocation of 80, 15, and 5. This disciplined approach of diversification, but also rebalancing periodically, helps me to sell high and buy low, which is a fundamental principle of investing. Rebalancing your portfolio ensures that your portfolio stays aligned with your risk tolerance and financial goals. I'm Mia Lee. You can take the girl off Wall Street, but you can't take the banker out of the whore. Thanks for listening, and drop me your comments, questions, and suggestions for future episodes.